Hello and welcome to today's summary on employee stock ownership brought to you by Argent Wealth Management. Today we'll be going over the various ways employee stock ownership can be given and received. My name is Tony Manhoot and I've been an advisor at Argent since 2021. I work on investment portfolio construction, tax return preparation, and estate planning, and I'm looking forward to sharing this important topic with you today. This recording is a snippet of a more comprehensive presentation that covers everything on this slide, and the full slide deck is already posted on our blog that I'll show later. The main ways employers give ownership in their company to employees are through units and options and ownership plans. They each have their own nuance when it comes to valuations, restrictions on selling, and how to time your actions to get the best tax treatment. And this content dives right into that. This chart summarizes the 5 most common methods of transferring stock ownership to employees and what happens when the value of the stock increases over time. Each example can be analyzed through the framework of what happens before you own the stock, or the pre-ownership period, what happens when you actually own the stock, and then the day the stock is sold. RSUs, or restricted stock units, are one of the most common wrappers stock ownership comes in. They're awarded to an employee and become taxable as compensation on your W-2 when they become vested. After they vest, the employee is free to sell the stock and it will follow typical capital gain treatment. The next 2 categories are stock options, which are incentive stock options, or non-qualified stock options, which are ISOs and NSOs. They're different from RSUs in that the company is not giving you stock, but instead the option to buy stock down the road. The employee won't receive the stock until they exercise the option to buy it. For ISOs, assuming specific requirements are met for a qualified disposition, income tax is deferred until the stock is sold, and the appreciation of the stock is taxed at capital gains rates, which is a great advantage because capital gains rates are more favorable than ordinary income tax rates. For NSOs, you have to pay your taxes along the way. When the option is exercised, you have to pick up ordinary income on the difference between the actual value of the stock and what you paid for it, and then capital gains treatment is applied on the appreciation since exercised once the stock is sold. The last 2 categories are both employee stock plans. Employee stock purchase plans, or ESPPs, open up a period of time for employees to contribute after-tax money to a separate account that accumulates over time. At the end of the offering period, the employee buys shares of stock with these funds at a discount to fair market value, and they can sell them at any time that they like. ESOPs, or ESOPs, employee stock ownership plans, are quite a bit different, as the employee doesn't contribute to them, but the employer does, and it's on a pre-tax basis as opposed to a post-tax basis. It's kind of similar to a non-elective 401k contribution. At retirement, should you elect to use the net unrealized appreciation method, which we'll get into in a second, the stock is distributed to you into your taxable brokerage account, and you'll pay ordinary income tax on it. However, the benefit of an ESOP is that you only pay ordinary income on the amount the employer contributed to you and not on the appreciation of the stock over time. That net unrealized appreciation will get taxed at capital gains rates once the stock is sold. In the full presentation, I go over the pros and cons of using the net unrealized appreciation technique. So that was a brief summary of the various packages that employee stock can come in, but it only scratches the surface of their complexities. You can check out the blog on our website linked here where we've posted the full slide deck. The full presentation covers definitions and examples of the topics we touched on today, as well as tax planning techniques and overall guidance for these intricate topics. Our other socials are listed here as well, so feel free to give us a follow to stay up to date on finance's most relevant topics. And one last thing, if you ever know someone that could benefit from investments, estate, tax, and retirement planning all under one roof, never hesitate to let them know about Argent. You can always reach out to the advisors directly or contact us at contact@argentwm.com. Again, this is Tony Manhoot, and thank you so much for taking the time to listen today.